Good morning, everybody. I'm Clark Schweitzer, Senior Wealth Advisor here at Diversified, out of our Wayne, Pennsylvania office. And I'm joined by my esteemed colleague, Michael Horwath, our CIO, Chief Investment Officer here at Diversified. And it's been quite a few interesting weeks here that we've been dealing with. And it's timely that we get together here with Mike to kind of give us updates. I think during these times, we haven't really experienced much in the last 2 years, but it's very emotional, very polarizing, and we understand from talking with all of our clients that these are the best times to really recommunicate and over communicate what's going on, what we're thinking, where our heads are at with all of this, and really kind of unpack where we think we're going from here, but also what you all should be thinking. I think it's a good time to always reflect back on, the investments are one half of the equation and the financial planning is another. And those two married together is a very important recipe for the overall success. So, we're going to give you a nice update here through Mike on kind of where we're headed here and what we're thinking. And then I'll take some questions at the end. The webinar replay will be sent out. So if for any reason you have to jump off early, you will get a copy here to rewatch and share with friends and family. But with that, I'll turn it over to Mike here, and we'll take some questions at the end.
Beautiful. Thanks, Clark. It's your first time doing this. It's great.
Thank you.
So welcome, everybody. As many of you know, this is our normal quarterly webinar. We like to do these quarterly ties together with my quarterly newsletter, and it's usually a chance for me to just recap what happened in the previous quarter, talk about things that are timely, pretty much just regroup from the quarter that was and what we're looking at moving forward. Naturally, the timing's pretty important here, and why we were happy that this was scheduled at this given time, just because there's a lot going on. Right, I'm not saying anything that anybody doesn't know, and it's probably a big reason why it's one of our most highly attended webinars, because there's a lot of uncertainty. We're going to go through a whole bunch of stuff. But once again, my name is Mike Horwath. I'm the Chief Investment Officer here at Diversified. Let me just kind of first start. We've communicated a bunch, sometimes a little bit more just one-offs. Many of you saw my newsletter come out. One of the things I want to emphasize from just an upfront disclosure perspective is this is a polarizing time, right? In general, right, we can overgeneralize this to death. A lot of this is super polarizing, and what we're going to go through just from what's happening, how we're viewing it, the good, the bad, how we're positioning, what we're doing, what we're not doing, is from that perspective, how we're viewing portfolios, how we're thinking about it from a financial plan, from a long-term investment perspective. It's not meant to minimize anything that's happening. It's not meant to exacerbate anything that's happening. It's just meant to give our perspective on what's going on. And I think I just want to make sure we kind of start with that, because there's a lot going on. There's a lot of emotions, one way or the other. And I think that getting that out there is a pretty important thing. But look, the elephant in the room is this, right? The uncertainty of what's going on from an economic policy perspective. So this is kind of going back several decades of just a way to measure policy uncertainty. Look, we haven't seen this since COVID, right? Which was not that long ago. And I think there's a lot of similarities to right now and to what happened during the COVID time, which many, many differences, but a lot of similarities in many ways. But what you can see, and the thing I want you to take out of this is, it is as uncertain as you would expect, right? And what this is measuring is the amount of media, whether it be right, left, center, doesn't matter, newspapers, digital media. At the end of the day, the number of uncertain topics, right? The words that are being used, the lack of clarity, the way to measure it, they look at that level from an uncertainty perspective. I'm not saying anything that's a shocker, right? Things are uncertain. Tariffs have now become a big part of it. There is a clear change from this administration how they want to approach economic policy. And we're living through it. And markets, people are all living, consumers, businesses, they're all kind of working through it together to figure out what's actually happening, right? And you're seeing it in real time. But this is the elephant in the room. If we kind of just say what's happened in Q1, clearly I'm not going to spend much time on this because as of 3/31, while markets had kind of pulled back off their highs, you'll see the S&P at that time at the end of the quarter was down about 4%, right? Global markets were down about 1%. A little bit's changed since then, right? But at that point, US fixed income was actually positive 2.78% at that time. So at the end of the quarter, it was clearly a different picture than what is going on today, right? There's been some changes since the end of the quarter. You'll kind of look at right back to the elephant in the room. Since April 2nd, right, the drop in markets has been pretty sizable, right? This is a year-to-date picture of the S&P 500. You see, as of, I believe it was Monday, the S&P was down about 13% on the year. So peak to trough of its high to its low was down closer to 17, 18% at that point. So many of you who don't know, a 10% fall in equity markets or in an index is referred to as a correction. So whenever anybody says markets are going through a correction, it's a 10% peak to trough. Now that can mean markets went up 10% for the year and they dropped back down to flat for the year. That's a 10% peak to trough drop. You're still flat on the year, but from its peak to its trough. At 20% is where you start to hear the word or the term bear market come into play. But this is really the elephant in the room. You're seeing equity markets, both here in the US, mostly in the US, but also globally, especially more recently, start to really try to reprice themselves as to what is going on, right? And a ton of uncertainty. And the reason why I say there's some similarities to COVID, one, February 19th is going to be engraved in my head for a long time. And February 19th was the peak of equity markets in 2020. Now we know that markets troughed on March 23rd of 2020, right? It was a very, very quick fall. We don't know if we hit that point yet here in the US or here in 2025, but here in 2025, February 19th was also the peak from an equity market perspective. And I think just like then, the lack of clarity, the cloudiness as you look forward and trying to understand the impacts of policies, the impacts of what's going on. It's not just consumers, it's businesses, it's politicians. I mean, it's across the board where everybody's trying to figure out what the long-term impacts are, what the outlook becomes, and kind of how to position yourself, how to think about it. And that's what we're working through today. And that's what we want to kind of chat through today. So what happened? I think many of you already know, but if you don't, let's go back to the first quarter. Right, so before April 2nd, when the new administration came to the office, one of the things that they were focused on was implementing tariffs. And really the focus up front was Canada and Mexico, who are sizable trading partners, right? But the word tariff has been thrown out throughout the campaign leading up to the election, since the election, and naturally since Inauguration Day. Tariffs have been thrown out, and since April 2nd, right, Liberation Day as it was called, was this sweeping tariff policy for pretty much all countries around the globe. Now, what you saw was pretty much a universal 10% tariff, and then tariffs that were essentially adjusted for the worst offenders, as it was called. So the offenders would be the individuals who have the biggest trade surpluses on their side, right? So the US has the worst or a bigger trade deficit with those countries. And many are the ones you would think about, right? The ones that are big exporters, the ones that especially export goods, right? This is mostly around goods. This is really nothing to do with services. It's mostly goods, right? So if you think about it, the US largely imports a lot of goods, right? I mean, that's just what we do. And we export a lot of services, right? You think about the technology sector as a whole, we export services heavily, but we import goods pretty sizably. And especially some of our trading partners in Southeast Asia, namely obviously China being one, but Vietnam and others are huge trading partners, and there are sizable trade deficits. And what this administration is looking to do is, in their opinion, correct that through the use of tariffs. Now, for those of you who don't know as well, many of you I'm sure have spent time digging into what a tariff is if you didn't already know, but a tariff is essentially a one-time tax on imports. So if we buy a good from, or we import a good from China, Japan, whoever, it comes into the country and it is hit with a tax, right? That is what the tariff is, a one-time essential cost. And there's ways to work around it, right? The exporting country could lower the price so that the tariff that's imported or that's it's slapped on the good now ultimately makes the price the same. The importer could have to absorb it, right, and ultimately make less money, or it could get passed along to the consumer. Very logical as well. So prices move up. So you're hearing different potential outcomes, and that's what the world's trying to understand right now. And then the other component becomes what ultimately happens with our trade partners, our long-term trade partners, because what could happen and what has already started to happen are essentially trade wars. You saw it in the first quarter with Canada and Mexico, right? Very close trade partners of the US. But it becomes a little bit of a tit for tat conversation. You're seeing it now with China, right? Which isn't a surprise given the two largest economies in the world. China exports a lot to us. You're starting to see this tit for tat trade war, right? Escalation, right? At the end of the day, we don't view that as good for anybody. And the question becomes, what is the outcome of it, right? What's the impact? Where's the landing point? Where is the negotiation, if any, right? I think there's a lot to be figured out. And this is what obviously is concerning markets. And ultimately, it's like really just trying to figure out what the overall impacts are. You can see it on the right-hand side, how drastic of a change in economic policy this is. We always talk about from a market standpoint. The markets are very interesting. When I say markets, just let's stick with equity and fixed income markets, public markets. The amazing part about equity and fixed income public markets is they are real-time representations of outlooks, of expectations moving forward. It is a real-time understanding of how the market views what's going to happen. And that's across many things, right? It's from the macroeconomic perspective, but at the end of the day, corporate earnings, corporate fundamentals to pay back the debt and fixed income, right? Bonds are just corporate debt or US debt, other sovereign debt, municipality debt. It's a real-time reflection. And this change in economic policy, and you can see it in the graphic, we haven't seen this level of duties from a tariff perspective since the early 1900s, right? So a lot is being absorbed, a lot is being, trying to be understood, and candidly, it's very, very cloudy, right? But the impacts are really what we're focused on. What are the potential bad, both today and as we look forward, right? Tariff uncertainty in general is going to create volatility. What you're seeing as well is you're seeing companies, I think Walmart just came out, they took off forward guidance, meaning they're not willing to say what they expect from an earnings perspective, a margin, revenue, sale, like all these things. They're not willing to put that out at this point because they don't know. Just quite frankly, they don't know what the table stakes are. What we do know is that there are impacts. I think anybody who will say that there are not impacts, if you just look at tariffs in a silo, I think is being disingenuous, right? In a silo, tariffs will typically generate inflation, right? It is a one-time cost impact, right? Inflation will likely move up in a silo. It likely will also impact GDP growth. So you're hearing it over and over again. You're going to hear the R word, recession, recession, recession. At the end of the day, it's where does economic growth go? Well, are consumers confident to spend money? Because half of this is confidence. A big part of it is confidence. You've seen consumer sentiment drop, but what will the consumer do? Will they cut spending? Will they change where they spend it? What will corporations do? Are margins going to be compressed? Because we've always said earnings are going to drive markets. Over the long term, you overlay earnings per share and the price of an index that represents those businesses, they look very, very close. Earnings will drive everything. But what ultimately happens if GDP growth starts to pull back, people spend less, where do earnings go? Likely down. To what extent? And you've seen a lot of this priced into markets already, right? It's a very, very quick repricing. And that is our focus of what's real, what's an overreaction. And a lot of this is still cloudy across both the macroeconomic and then at the company level. The other component, you look at is the Fed's going to potentially have to make some decisions here, and it's going to be a tough one. So if you don't remember, the Fed has two main mandates. Their mandate one is to maintain low positive inflation, right? Stable prices is what they would call it. They want a 2% price target. That number is willing to be flexible, but call it 2%. Inflation today is above that year over year. It's pretty much flatlined. So even though we're slightly above it, it's not too far, but we're still above it. We're not coming at this from a below target inflation level. They also want to maintain full employment. Full employment is kind of where we've been. 4% unemployment. The labor market's been a pretty good story. You've seen wage growth be a really good story. We'll see how the government job situation impacts the numbers in the short term. But the Fed, if unemployment were to tick up, and if growth were to contract, naturally what they would want to do is to cut rates. Right? They want to cut rates so that they can stimulate the economy and hopefully bring back down unemployment if it were to tick up, which it hasn't yet, but this is what we're trying to look out for at this point. On the other side of the coin, right, you have inflation. What if inflation does pick up? Because when inflation picks up in 2022, what happened? Rates were raised sizably, about 5.25%. Over the full hiking cycle, got to 5.25 on the short term. So if those mandates are at odds, where inflation requires you to raise rates, unemployment, sluggish growth requires you to cut rates to stimulate the economy, what does the Fed prioritize? What you've seen markets do is price in more cuts. Now, today you're seeing some reversal in that. And I think this is where the market, especially on the bond side, is trying to identify where the Fed's going to go. You're going to start to see, when Jay Powell, the chairman of the Fed, comes out, his words are going to mean a lot to market participants because they're going to try to understand where the Fed's going to go. Are they going to be accommodative? Are they going to hold rates steady until they're comfortable with inflation and say, hey, we're going to take a little bit of it on the chin if unemployment picks up? These are the things we're all looking through. What I always encourage people, and this is what I've called the newsletters, to resist the urge to, and I would say it in quotes, right? To just do something. When I say just doing something, going to cash, right? Changing the way you view your financial plan. This is the kind of time where it pays to revisit the plan, what the objective is, what our targets are, what our outlooks are on portfolio returns, right? Our portfolio returns are over long periods of time. This is why we stress test portfolios. But I resist the urge to just do something. On the other side of the conversation is not everything is painful right now. And we're keeping a keen eye on it, but not everything is painful from an economic perspective. So the bond market is a great indicator of how we look at economic conditions. Something called bond spreads, right? And not to get too in the weeds, but bond spreads refer to how much you're going to be compensated for taking on what we would call credit risk, right? A company that's a worse credit risk than a AAA rated business, right? There's only a couple, or AA rated business. How much are you being compensated to take that? Tells you how, versus U.S. Treasuries, right? Taking a corporate bond risk versus Treasury bonds, right? Which in theory are risk free. It tells you the market's belief from a default standpoint. It tells you how they think corporate fundamentals are. Bond spreads have been super tight, meaning that you haven't been compensated a ton to take on what we call credit risk, right? To go buy a corporate bond over a government bond, because corporate fundamentals, especially going back to 2020 when everybody refinanced their debt, have been really strong. Now, that has widened a little bit, meaning some of this has been kind of unwound. Some of it's gotten a little bit worse, right? But we're far from times like 2020 where this thing got so exacerbated. Do those bond spreads remain tight as they have? The labor market has remained tight. You just saw the March payrolls at 228,000. Naturally, we have to see what happens from a government perspective with a lot of the changes within the departments, layoffs, buyouts, all of those things. But when you look at the labor market, that's been one of the best places to focus because one, you have full employment now it's 4.2, but it's been anywhere from the high threes to the low fours, full employment, been adding jobs, and you've seen wage growth outpacing inflation, which is an important part, right? As long as wage growth is outpacing inflation, you don't worry so much about the consumer because look, the average wage growth is outpacing the average cost increase. Doesn't mean that that's for every income level, but on average, that's what it looks like. And the consumer coming into this is a big reason to remain positive. The consumer coming off of several years of strong markets. We've seen debt levels start to increase a little bit, but by and large, a consumer and aggregate net worth has never been higher. There's still a lot of cash on the sidelines. Employment looks really good. The consumer comes at this from a healthy perspective. Once again, it's not across the board, right? The lowest income individuals will likely be hit hardest from a tariff perspective. Corporate profits obviously are going to be the big part of this. It's been one of the big reasons why we've been so constructive in 23 and then 24 on equity markets is that you just saw an equity or a corporate landscape where S&P 500, we'll pick on the US large cap space, the corporate profits and margins were super healthy and the growth was there. What you're seeing is while we came into the year in a healthy spot, markets are pricing in what happens from a margin and earning perspective. Even top line growth, right? Top line revenue growth. There's so much uncertainty. A lot of these companies don't even know what's going to happen at this point. So while that's the good news, obviously there's a lot. This is a fluid situation that we're constantly monitoring. Every day there's something new. We're trying to read into corporate conditions. We're trying to read into macroeconomic landscape, the consumer. So all of these things are on the table that we're focused on. Kind of taking a step back. I remind, many people have been through this with us for decades at this point. We go back to 2022, 2020, 2018. Look, market pullbacks, regardless of the reason, are healthy and normal. Now, it doesn't feel healthy and normal today, right? It's hard to say that in the moment. March 23rd was one of the days or right around the days of 2020 where we were about to go work from home for 2 years. It didn't feel healthy and normal. But what market pullbacks do is they refresh prices. They reprice things to get back to healthy levels after most times momentum drives markets a little bit above probably where they should be. So what you've seen is some things start to unwind. What things that have sold off the most are the things that rallied the hardest. We'll talk a little bit more about this. But by and large, one, pullbacks are healthy and they're normal. I don't know that most people know this, but on a peak to trough standpoint, markets on average have 3.5-ish, right? Just over 3 times per year that they drop from 1% to X percent, whatever it is, down 5, right? So they drop 5% peak to trough at any given point in the year on average 3 times a year. It's normal. 10% happens, a correction happens about every 16 months. Not every year, but almost every year. These things are more normal than I think people realize. But it's happened so quickly, and that's a big part of it. As we look kind of forward, one of the things we've been focused on is in the moment, just like in 2020, in 2022, towards the later part of it, it feels, you can see it here in October, you had just come off sizable declines on the right-hand side of the screen. And on a forward-looking basis, what it does is it does tend to give yourself a positive outlook. I don't know the timing. I'm not going to predict that because I don't know. Right? And I think anybody who does tell you that they know is kind of lying to themselves or doesn't have the humility to admit that they don't. But history tells us that these pullbacks happen and that the rebound also happens. Right? It may take 1, 2, 3 years. We'll see. But this is why we're focused on long-term perspectives, especially in equity markets, and we're diversified individuals, right? Going back to this shows calendar year returns, right? The bar is the calendar year return of the S&P 500. In the last 45 years, the S&P 500 has been positive in 34 of those years. But in every single one of those years, you'll see the red dot. That is the largest peak to trough drop during that year. So even last year, right, or the year before, where you saw mid 20% returns, you saw 8 and 10% drops from peak to trough in markets during those years, right? It is healthy and it is normal, even though the external factors don't feel that way. Here's an important perspective that I think many people have lost throughout this, because so much, and I think part of it is, one, is not presented this way. 2, financial markets don't focus on it in this way. But most investors, and this is why we focus on diversification. Diversification isn't great in years like 23 and 24, where the S&P 500 that everybody focuses on is up mid-20s. And a diversified investor is up in the teens. But this is the time when it comes in most handy, right? Because through Monday, the S&P 500, like I showed, was down over 13%, nearly 14% on the year. And I think that gets the focus. Not only is it down 13, almost 14% on the year, it's down 17, 18% from its peak in February. However, somebody who is diversified that owns small cap, which actually hasn't performed great during this time period either, but international stocks, both developed and emerging, and then fixed income, right? Bonds is a big part of what we use as a diversifier. That individual was down 5, 6% less as a 60, 70% stock individual in a diversified portfolio. And I think once I've given that perspective to a lot of people, I think it's helped bring why we do it the way we do it. Right? Why? And it's not just us, right? I think that is just a fundamental belief across the it's investing 101, if you will, as to why we'll do things like that, right? But other asset classes have helped, especially something like fixed income, where there's been this flock to safety, right? Where through Monday, the ag was up 2.5% on the year. Well, having a chunk of your portfolio to more stable assets like fixed income, namely bonds, has been a big help from a diversifier standpoint. Next is, I'll be honest, it is hard to remember, but the worst times from a feeling, from a sentiment perspective, are often the best times on a forward-looking basis. JP Morgan puts out this great chart, and it's a great reminder that during the times when sentiment is the worst, is often the best time from a forward-looking return standpoint. And vice versa. When things feel the best, they're often a little bit inflated. Not enough potential negative outcomes are priced into markets. And your returns are a little bit more muted. So you look historically at the bottom numbers here, the blue dots on the bottom side of the graphic show the forward-looking return at sentiment troughs versus the ones on the peak side. And what you notice is that the numbers on the bottom tend to be higher on average, sometimes sizably higher, because just so much pessimism is built into markets that most investors lose the short-term perspective. So sentiment like this is an important thing to remember, that when things feel the worst is often when, on a forward-looking basis, is one of the best opportunities to stay invested, add funds. We're not trying to predict the next 6, 12 months per se. But I think it's an important, things get cheaper. A lot of negative stuff gets built in. And I think that's an important reminder at a time when sentiment is not at its worst, but it's pretty low right now. And I think you can feel that. And then the last perspective is just to zoom out. When we show people and our investors, our clients, why they own equities, we always show these graphics of the S&P 500, the ACWI, right? The All Country Equity Index. Over the course of 4, 5, 6 decades, maybe longer. And people, we shake our heads, right? We know equity markets have risen really well over the course of the last several decades, last century. At any point in that graphic, if you zoomed in over a 6-month period, there are plenty of massive pullbacks, plenty. At any point in time, you're going to hear things are overvalued. It's not going to work anymore. Equity markets are done. Going to cash, going to bonds, going to gold. But look what's happened when you zoom out. And I think that's an important reminder, is that we have to zoom out and think in years, multiple years, and not days and weeks. And it's not to say that markets pulling back can't affect our portfolios or how we think about our portfolios, but this is why, from an investment perspective, we diversify, and especially those investors who are entering retirement and need income. It's why we will not recommend being 100% equity unless there is no reason to own anything like that. So owning fixed income, being diversified, doing things like that are so important to diversify, and letting your equity markets work over time, right? And zooming out and getting out of that day to day, because living day to day becomes very, very difficult to absorb and to really stomach as an equity investor. I thought I would spend a few minutes kind of towards the end here just talking about how we're positioned, what we're doing, how we're thinking about it, some of the questions we're getting, some of those things from a positioning perspective. We haven't changed a ton, right? I think one of the things we've done towards the end of last year is we had said that the Magnificent Seven was getting pretty pricey. And one of our focuses was to kind of trim how overweight the S&P 500 was getting to the big 7 technology companies, or the Mag 7, the old FANG stocks, if you will. And but we remained heavily allocated to US large cap. But we've tilted towards more of a dividend positioning, right? But we also own international. We've remained steadfast in why we own international. So if you look at our normal portfolios, we tend to own international at a smaller weighting, right? We don't own 40% like the US or the global markets do, but we'll own 15%. And we've been making sure that investors kept and steadfast with that international position. We actually went through a manager search earlier this year, and we started looking at new positions within that international space. But we've remained about 15% of our equity portfolio is a preference to international. Within fixed income, we've kind of held steady in terms of owning mostly core fixed income. When we say core fixed income, we mean investment grade treasuries, investment grade corporates, mortgage-backed securities, right? But investment grade, we're a little bit light on high yield, right? We'll own some, but given how tight spreads were like we didn't feel like we were being compensated a ton. But we've owned plenty of core fixed income because we needed to act in times like this, like bonds need to act, right? And we've seen a flock to fixed income across the markets a little bit. So it's been very helpful to own fixed income at a time like this and be diversified. Some of the things we are also doing, we've been rebalancing portfolios. I can't stress enough that in both good and bad markets, you should be looking to rebalance portfolios. And it's something that we like to do. Sometimes we'll do it as part of a bigger change to how we are weighting portfolios. This year was more about tactically doing it after markets had both run really well after 24, and we started to see some movement in the early part of the year with equity markets starting to pull back in the first quarter. But rebalancing and then using those cash flows, right? So inflows and outflows of accounts, you can use that to rebalance and bring portfolios back into balance. Meaning in 24, when equity markets run, you become a little bit overweight to equities. What you can do is strategically rebalance it back and get back to your target and take those gains, buy something like fixed income that had performed worse, And then something like this year, doing vice versa. So after some of the pullback in equity markets, using some of the fixed income that's held up well to get your equity market back to target. Things like that are what we're doing. And then secondarily, we're looking at loss harvesting, right? I think now is a time where if portfolios are dropping, harvesting losses in taxable accounts where there's options, right? Where there's availability makes a lot of sense. It's a nice strategic thing to do that we like to do it towards, the middle to the back half of the year to look for those opportunities, or when things are a little bit more volatile to the downside. What tax loss harvesting means is selling an asset that is at a tax loss in a taxable account, capturing that loss, reinvesting the proceeds out to keep your allocation intact. But it's just a very strategic way to leverage market volatility and to manage taxes as you look forward. So just some highlights from some of the things I'm describing, right? So the S&P 500 from its peak to its trough, right, was down about 17.5%. The run up in the Mag 7 names, right? Big tech, you think Amazon, Alphabet, which is Google, Meta, Nvidia, Microsoft, Tesla, Apple, the big tech names. A lot of that concentration, they have become major weights in the S&P 500. And one of the things we were focused on late last year was trying to trim that, trying to just get away from that concentration a little bit. Even though we still love the businesses, we felt like they ran and became a little bit too expensive. And what you've seen this year are in a time where markets pull back, they're some of the first to get hit. And on the right-hand side shows the graphics. And what you can see is that most of those tech names are down 20% plus, sometimes 25% plus, with Tesla being down 35% this year. And in its place, what we've been trying to do is look to add to something that's more dividend focused. So as an example, that's higher quality, typically more dividend focused, more utilities, staples, a little bit of energy, which hasn't done as well this year. But even that, from a peak to trough, that stability has been better in the equity side, down about 10.7% from its peak, right? So being diversified and leaning away from those big tech names has helped. International equities, we've gotten a lot of questions on that. Like I said, we own international, both developed and emerging. We own it at a lower weight than the global markets, and it's not something we want to be heavily into typically for a variety of reasons. But that diversification has also helped. While it's not held up as well the last couple of weeks, even up to Monday, international equities have outperformed the S&P by 6%, been helpful to diversification. And then naturally, owning fixed income at a time like this, where you start to see that pullback, right? This is why we diversify and try to manage risk by also owning fixed income. Investment grade bonds measured by the US Ag Index, from that same peak to trough perspective, when it was down 17.5%, through, from February 19th through pretty much Monday, investment grade fixed income was up about 1.6%, right? So that part of the portfolio is held up at a time like this, right? And remaining diversified and allowing your equity portfolio the time it needs to recover, which could be months, could be years, right? That's something that we're going to be focused on as we move forward in managing portfolios for our clients. So just kind of final words before I kind of turn it over to Clark here is, there's a line we use in our weekly market update from 2020, and we've kept it there, but it feels hokey at times, but it's so true that we build these financial plans not when things are easy. In 2023 and 2024, when equity markets are rallying, diversified portfolios are up double digits in the mid-teens, up to 20%. We're not building, the plan captures that, but we're building these plans to give confidence that in the downturns, that we're positioned in a way that can withstand it. Your financial plan can survive it, right? And on the other end of it, we're going to get you where you need to be 10, 15, 20, 25 years down the road by sticking to that plan and making small changes along the way, and then revisiting it, right? If there's any questions about it, right? And changing the assumptions and things like that. So obviously, I know it's an emotional time. Turn over to questions here, Clark, but I always appreciate the questions we have received up to this point. I understand it, and I don't want to either exacerbate some of the issues that some people maybe think, or maybe minimize in some other people's minds. But I want to make sure we kind of give a full roundabout view of what we're seeing, what we're focused on, and how we're thinking about things. Clark?
Thank you, Mike. It's you answered a lot of questions. I'm sure you created a lot more questions after giving some of those charts, and a lot of the effect of the charts and the history is important. And all we have to go on is history at this point, right? Because a lot of times we see these markets, and it seems like these polarizing, which is our big word for the day, markets get much more attention than the golden ages we just went through, or the 1982 or 87 to 2000 run that we had, that is there in history but often forgotten because of these 1 or 2 year periods that just totally commandeer what the plan is dictated. So thanks for sharing that. So a couple questions that have come through. I think one of the big ones around the tariff piece is, given the stance that everyone's being tariffed now, and our positioning of always maintaining diversification, where do you see us going with our exposure to international, and how do you think the international markets fare during all this and then coming out of it?
Yeah, it's a question we've gotten, and I think it comes from a couple different angles. One, it initially started with with the US pushing Europe, and Europe kind of finally making a stance that they want to fund their own defense, especially with regards to Russia, Ukraine, right? It feels like ages ago that this conversation was happening, but a lot of the European allies, came out saying they want to spend, right? They're going to, Germany being kind of one of the people, the countries at the forefront, spending more as a percentage of GDP to self-defend on the European side of things. And we started getting questions around owning more international. And from our standpoint, there's a couple of things that we look at. One, we tend to have a bias towards the US, right? One, it's more familiar. And two, look, at the end of the day, from a business perspective, I think if you look at the way the US markets are settled, is one of the best opportunity sets for investing. You've seen it from a growth standpoint, the rise of the tech sector, the biggest businesses in the world, the margins, right? The opportunity set for the US doesn't mean that there's not opportunities internationally, right? And what's interesting is for a very long time, we've had to justify why we would even own international. One, you get the diversification benefit, but two, I think people forget that there are a lot of good businesses, both in the developed world, right? Europe, Japan, and in emerging markets. And we tend to do it in a more concentrated way, in a smaller weighting. Some of the reasons we're getting for individuals wanting to add more is, one, because of tariffs, two, because if you do see a weakening of the US dollar, that will be a tailwind for international equities for domestic investors. At this point, we're not running into international markets, right? We like our allocation. We want to maintain it. We're not reducing it in any way. What we're careful about is so much, going back to what drives US equity prices, is underlying corporate earnings, right? And the growth landscape. And if you look at Europe as an example, even if the US has a contraction in growth, Europe's growth outlook is worse than the US's, right? They don't have the margin expansion. They don't have the growth sectors that we have. And it's something that we're just concerned about, of leaning into something just from a hoping that the dollar, weakens to give us a tailwind. Well, we want the diversification. We want, if you think about some of the names that our allocations own in that space, you think of the Novo Nordisk with the GLP-1 drugs. You think of ASML, which is tied to TSM, right? The Taiwan Semiconductor, who's tied to NVIDIA. A lot of these things all work together, and we like the allocations. But we're not at a point where we feel that the macro landscape of Europe or Japan is so much more conducive to growth, or especially to corporate earnings, than here in the US. So from us, it's going to remain a diversifier. It's going to be more concentrated, typically a little bit more active in that space. And we are open to increasing it, but we need to see the underlying factors improve before we're going to run to it just from a weakening dollar standpoint, or until we even have clarity on where these tariffs land 6-12 months from now. We need to have better clarity on that.
Got it. Okay. And staying on the tariff conversation, obviously we've heard from the administration about the reasoning for the tariffs, create a better trade balance, potentially bring back jobs to the US here, create more employment, where I think you had said earlier that we right now are almost at a pretty good total employment spot. So what else is there in your mind that you've heard that the tariffs could be positive to potentially help bring back to the US?
Yeah, I mean, I'm not sure I view a whole lot more positive, if I'm being perfectly candid. I think the conversation of trade deficit versus trade surplus is fine, right? I think that should be transparent. And I think as a bargaining chip, I get it, right? Having the ability to negotiate with, you know, foreign economies that are maybe a little bit close to the US, right? Maybe we open up our economies to import a lot of things, and maybe our exports are not as open to other economies, which we want to fix. I think where we have to be careful is, one, I don't think it's as easy as slapping tariffs onto goods and all of a sudden we're going to see Nike start to onshore their shoes. I just think there's too many steps between A and Z to make that happen, especially during a single term presidency potentially. Uh, there's a lot of business decisions that need to happen. So from my standpoint, I think from a positive, bringing negotiation to the table, I think the idea of generating revenue where potentially, and look, we don't know yet, and nobody knows quite where it's going to go except the people making the decisions. But the idea being generating tax revenue from a tariff standpoint, and then on the other end of it, cutting taxes, right? A more accommodative tax standpoint to essentially offset the increase in cost, the generation of tax revenue from the tariffs. That would naturally be supportive then of markets, but we don't know what that looks like. Is it at the corporate level? Is it at the personal income level? What does government spending look like? I think that's the other component of it. But if we're sitting here saying, hey, what are the benefits? Obviously, you're going to get revenue. You're going to be able to hopefully get more countries to the bargaining table to discuss trade, potential openness of markets. Beyond that, I think there's a lot to be determined. I don't know how much jobs coming back to America to do manufacturing is realistic, at least broad-based. Maybe things here and there, maybe things are going to get more nearshored or maybe other parts of the processes. But I think there's a lot of things that, from A to Z, like I said, in order to sit here and say that big industrial plants are coming back to the US. We are a service-based economy. While there are manufacturing jobs here, people go to school for services, right? And that's what we export a lot of. That's what we're really good at. And I'm not sure how much manufacturing is going to change in the short term.
Got it. And I think we have time for one more. So obviously, in these periods where markets can decline rapidly, no one likes to lose money, nor lose it very quickly. So, what have you all been considering on the investment team side, other opportunities or strategies to help reduce some of the downside risk, whether it's in different asset class or in different investments?
Yeah, that was a great question. So in terms of consideration, right, we're always looking for a couple different things, right? First and foremost, we will be diversified, but beyond just the core asset classes and how we allocate within them, right? We've tilted towards more stable U.S. large cap, kind of via dividend oriented equities. Other things, look, we're considering the concept of more precious metals. We're not there. It's probably not something we're looking to implement and jump into, but it's something we're certainly considering. The other component that we do look to implement is something called owning volatility, right? And by doing that, essentially what you're doing is owning hedged potential pieces, right? And using options. So people a lot of times know the VIX, right? The VIX is just a measure of volatility in the market. What you can do is own strategies, right? And we've begun implementing this in certain portfolios and are always looking to, does it make sense to add it more broad-based, is owning strategies that have more of the hedged component on the equity side, using options to protect the downside. The challenge right? The offset is that you pay for the protection, kind of like insurance, through maybe limiting upside. So some of the things that concern us and that we kind of bat this around and we're actively doing so is that, paying for downside protection and limiting upside after markets have begun to fall is that something that we feel is in the best interest of our clients to potentially limit the upside as well, right? Is it adding enough diversification? So beyond obviously fixed income, using different tools within the fixed income space or within equities to try to minimize risk, right? To go more stable in those asset classes, we'll look to, like I said, the volatility markets, which is typically strategies using options to help either manage downside risk to add income via using the call option space. So, obviously not getting too far into that, but it's something we're certainly considering. Obviously, still on the table in terms of precious metals or crypto. But like what we've seen with some of that, especially the crypto space, is kind of just acted like tech, right? And that's kind of been our concern, is that it's kind of hasn't decoupled from equity markets by and large. So all of these things are on the table, and things that we talk about is, can we enhance our diversification? What does it do? And one of the questions we'll always ask is, what does it do to our forward-looking return? Right? Because that's just as important to us, is that, we build out financial plans, and if we're trying to build a financial plan at an assumed 5-6% rate of return, whatever that is, we have to make sure that we are allocated in a way for our clients that their portfolio on a forward-looking basis, we believe it can achieve those rates of return, because that's what the plan needs, right? So that's something that we're really focused on, is, considering the enhanced diversification or things in, whether it be private markets or whether it be in options markets or kind of alternative pieces, all with the lens of, can we ensure that we're not sacrificing returns on the flip side over the long term that could be detrimental to our clients' financial plans.
Thank you. So that's great. Hopefully everyone, you've got a better sense of where we're viewing the markets right now, where markets are going, and the echoing of, look, markets are going to do what markets are going to do. We'll do our best to be ahead of what could potentially happen, or coming out of a situation like this. But it always falls back to the plan, right? We got to control the controllables, and if there's doubt in your mind or concern day to day, talk with us. Talk to your team at Diversified. Check in again, check in multiple times, but let us know so we can at least address what the plan looks like and have that projection going forward to make sure you understand and are confident that, all right, these periods happen. They're not fun. They're uncomfortable. They're not downright terrible to look at every single day. But, as we have the last 100 years of market conditions that have been like this, have gotten through, and we've seen new highs. So, it's part of the plan. Revisit the plan, and we'll work through it all.
Right. I mean, so much of this work has to be done before you get to the volatility. I think that's the great way to put it. Of so much of the work from a planning standpoint, from a portfolio positioning standpoint, should happen before you get to this point of making sure expectations and outlooks are the right way. So that's well said. And we're here. If you have any questions, you want to talk personally, right, about your situation, what your thoughts are, your concerns are, please reach out to your advisor. They'll pull in myself, my team as need be, and we'll talk through it. And we're, that's why we're here. And we want to make sure that we're going to listen, and we're going to give our feedback, and we'll work together through everything.
Perfect. Well, thank you, Mike. Thank you, everyone, for joining us. And if you have any unanswered questions, please feel free to reach out and chat through and get them answered.
Clark.
All right. See ya.